Summary of The Little Book of Common Sense Investing by John C. Bogle. John C. Bogle's The Little Book of Common Sense Investing is a straightforward and powerful guide to building wealth through low-cost, diversified, and long-term investment strategies. Bogle, the founder of Vanguard Group and the creator of the first index fund, advocates for a no-nonsense approach to investing that focuses on simplicity and discipline. Core concepts. 1. The power of indexing. Bogle's central thesis is that most investors should choose low-cost index funds over actively managed funds. Index funds, which track a market index like the S&P 500, offer broad market exposure, lower expenses, and reduced risks. Bogle argues that trying to beat the market through stock picking or market timing is futile for most investors, as it often results in higher fees and lower returns. 2. The importance of costs. One of the key messages in the book is the impact of investment costs on long-term returns. High fees from actively managed funds can significantly erode an investor's returns over time. Bogle emphasizes that keeping costs low is one of the most crucial factors in maximizing investment gains, and index funds, with their low expense ratios, are an effective way to do this. 3. The long-term approach. Bogle advises investors to focus on the long term and avoid the temptation to chase short-term market trends. He stresses the importance of patience and staying the course, even during market downturns. The book encourages a disciplined approach to investing, where regular contributions to a diversified portfolio are made over time, allowing the power of compounding to work its magic. 4. The failure of active management. Bogle presents compelling data showing that most actively managed funds fail to outperform their benchmark indexes over the long term. He explains that this underperformance is often due to the high costs associated with active management, as well as the difficulty of consistently making the right investment decisions. As a result, Bogle argues that investors are better off investing in a low-cost index fund that guarantees market returns rather than trying to beat the market. 5. Diversification and simplicity. The book advocates for diversification across asset classes to reduce risk. Bogle suggests that a simple portfolio consisting of a broad stock index fund and a bond index fund is sufficient for most investors. He discourages the need for complex investment strategies or chasing hot sectors, which often lead to disappointing results. 6. The role of bonds. While Bogle is a strong proponent of equity investing, he also highlights the importance of bonds in a diversified portfolio. Bonds provide stability and income, particularly for investors who are nearing retirement or have a lower risk tolerance. He recommends adjusting the allocation between stocks and bonds based on an investor's age, risk tolerance, and investment goals. Key takeaways. Stay the course. Stick with a long-term investment plan, regardless of market fluctuations. Keep costs low. Focus on minimizing investment fees and expenses. Diversify. Spread investments across different asset classes to reduce risk. Avoid market timing. Don't try to predict market movements. Instead, invest consistently over time. Invest in index funds. Opt for low-cost index funds that track broad market indices to ensure steady and reliable returns. Conclusion. Bogle's The Little Book of Common Sense Investing is a powerful argument for the simplicity and effectiveness of index investing. By focusing on low costs, diversification, and a long-term perspective, investors can build wealth steadily and avoid the pitfalls of more complicated investment strategies. The book serves as a timeless guide for anyone looking to achieve financial security through sound investing principles. Don't forget to like this video and subscribe to our channel for more insightful summaries of financial wisdom.